Most people who have a side income, a self-employed business, or any kind of income outside of regular employment think that the worst-case scenario with HMRC is simply paying the tax they owe. But that is not the worst case. Not even close. The worst case is paying the tax you owe, plus penalties on top of that, plus daily charges, plus percentage surcharges, plus interest on everything that is outstanding all at the same time. And in 2026, with new penalty systems coming in and HMRC receiving more data than ever before from online platforms, the risk of getting caught out has never been higher. Today, we are going to go through exactly how much you could actually owe HMRC if things go wrong. Not in vague terms, in real numbers. So you understand exactly what is at stake and what you need to do to protect yourself. This is general information and not personal tax advice. Penalty amounts depend on your specific situation, so always check Gov UK directly or speak to a qualified UK accountant or tax advisor for advice that applies to your personal circumstances. Today, we will cover late filing penalties, late payment penalties, failure to notify penalties, inaccuracy penalties, the new MTD penalty points system, how HMRC calculates interest, what behavior categories mean for your penalty level, and how to appeal or reduce a penalty. Let us start with the most common penalty, the late filing penalty for self-assessment tax returns. The deadline for filing your self-assessment tax return online is 31 January each year. If you miss that deadline, HMRC applies penalties in a very structured and escalating way. Day 1, after the deadline, you receive an automatic £100 penalty. This applies even if you have no tax to pay at all, even if your return shows zero tax liability. The £100 is for the filing being late, not for any unpaid tax. After 3 months, HMRC adds daily penalties of £10 per day. These run for up to 90 days, which means a potential additional £900 in daily charges alone. After 6 months, HMRC adds a further penalty of either 5% of the tax you owe or £300. Whichever is the higher amount. After 12 months, HMRC adds another penalty of either 5% of the tax you owe or £300, whichever is the higher amount. So in a worst-case scenario, where you are 12 months late filing and you owe a meaningful amount of tax, your penalties alone could be £100 plus £900 in daily charges, plus 2 rounds of 5% surcharges. That can add up to several £1,000s on top of the original tax owed before interest is even factored in. Now let us talk about late payment penalties, because these are separate from the late filing penalties and they stack on top. If you file your tax return on time but do not pay the tax you owe by 31 January, HMRC applies late payment penalties on top of everything else. At 30 days late, HMRC adds a 5% surcharge on the unpaid tax. At 6 months late, another 5% surcharge on the tax that is still unpaid. At 12 months late, another 5% surcharge on the remaining unpaid tax. So if you owed £2,000 in tax and paid it 12 months late, you could be looking at 3 rounds of 5% surcharges. That is, £100 at 30 days, another £100 at 6 months, and another £100 at 12 months. That is £300 in payment penalties on top of the original £2,000. And that is before we add the daily interest that runs from the very first day the payment is late. In 2026, HMRC's late payment interest rate is approximately 7.75% per year, calculated daily. So on £2,000 unpaid for 12 months, that is another £155 in interest charges on top of everything else. This is the penalty that catches side hustlers and self-employed people the most, and it is one of the least understood. A failure to notify penalty applies when you should have registered for self-assessment or notified HMRC about a new source of income, and you did not do it by the required deadline. The deadline to register is 5 October following the end of the tax year in which your income arose. So, if your gross trading income exceeded £1,000 in the 2025 to 2026 tax year, you should have registered by 5 October 2026. If you miss that deadline, the failure to notify penalty is based on the tax you owe, and it is categorized by your behavior. If HMRC decides your failure was genuine and non-deliberate, the penalty is typically between 10% and 30% of the tax owed. If your failure was careless, it is between 0% and 30%. If your failure was deliberate, it rises to between 20% and 70%. And if your failure was deliberate and concealed, it can be between 30% and 100% of the tax owed. This is why understanding your obligations and registering on time is so important. The failure to notify penalty is not a fixed amount, it is a percentage of tax owed. And it is calculated going back to when you should have notified HMRC, not just from the year you get caught. Beyond the filing and payment penalties, there is another category, inaccuracy penalties. These apply when there is an error on a tax return that results in you paying less tax than you should have. The penalty for an inaccuracy depends entirely on the behavior behind it. If the inaccuracy was careless, meaning you did not take reasonable care, but it was not intentional, the penalty is between 0% and 30% of the additional tax due. If the inaccuracy was deliberate but not concealed, meaning you knew it was wrong but did not try to hide it, the penalty is between 20% and 70% of the additional tax due. If the inaccuracy was deliberate and concealed, meaning you knew it was wrong and took active steps to hide it, the penalty is between 30% and 100% of the additional tax due. The key point here is that HMRC does not only go after people who deliberately evade tax. Careless errors are penalized too. Not knowing the rules is not a complete defense. If HMRC determines you did not take reasonable care, a penalty can apply even if the mistake was entirely unintentional. This is why good record-keeping matters so much. It is evidence that you took reasonable care, and that can be the difference between a 0% and a 30% penalty on a careless inaccuracy. From April 2026, a brand new penalty system went live for making tax digital for income tax, and it works very differently from the traditional penalty structure. Instead of automatic fixed penalties for missing deadlines, the MTD penalty system is based on points similar to points on a driving license. Here is how it works. Every time you miss a quarterly submission deadline under MTD, you receive 1 penalty point. When your points reach a certain threshold, a financial penalty of £200 is triggered. For quarterly filers, which is what MTD for income tax requires, the threshold is 4 points, so miss 4 quarterly submissions and you receive a £200 penalty. But here is where it gets more serious. After the £200 penalty is triggered, every subsequent missed submission adds another £200 penalty. And your points do not reset immediately. You have to achieve a period of full compliance before your points can begin to be removed. The important thing to understand is that this system is specifically designed to deal with repeated non-compliance. One missed submission does not immediately cost you money, it costs you a point. But the accumulation of points escalates quickly if you continue to miss deadlines. Now here is something that surprises a lot of people. Interest is charged on top of penalties, not just on unpaid tax. HMRC charges late payment interest from the very first day tax is overdue. In 2026, that rate is approximately 7.75% per year, calculated on a daily basis. This means every day that passes with unpaid tax, interest is accumulating. And interest is not just charged on the original tax owed, it is also charged on unpaid penalties. So if you have a £100 late filing penalty and you do not pay it, interest starts accumulating on that £100 as well. For someone with a significant tax bill that remains unpaid for a long period, interest alone can become a substantial additional cost on top of the original liability and the penalties. There is one saving grace. HMRC does pay interest on tax that you have overpaid. The repayment interest rate in 2026 is lower than the late payment rate, but it does exist. However, given the rates involved, overpaying and waiting for a repayment is still not a strategy. The goal is always to pay the right amount at the right time. One of the most important concepts to understand when it comes to HMRC penalties is how your behavior affects the level of penalty you receive. HMRC categorizes behavior into 4 levels when determining penalty percentages. The first is prompted disclosure with no deliberate behavior. This means you made a mistake, HMRC prompted you to correct it, and the error was not deliberate. Penalties in this category can be significantly reduced, sometimes to 0, if HMRC accepts there was a genuine and reasonable mistake. The second is unprompted disclosure with careless behavior. You identified the error yourself, came forward voluntarily, and the error was due to carelessness rather than intent. Penalties here are lower than if HMRC found it first. The third is deliberate but not concealed. You knew the information was wrong but did not actively try to hide the error. Penalties here are higher, typically starting at 20% of the tax owed. The fourth and most serious is deliberate and concealed. You knew the information was wrong and took active steps to hide it. This attracts the highest penalties, up to 100% of the tax owed in some cases. The practical takeaway is this: coming forward voluntarily, being transparent, and cooperating fully with HMRC will always result in a lower penalty than being discovered and resisting. Behavior matters enormously in how HMRC calculates what you owe. If you receive an HMRC penalty, you do have the right to appeal, and a key ground for appeal is what is called a reasonable excuse. A reasonable excuse is a situation or event that is outside your control and that prevented you from meeting your tax obligation by the required deadline. HMRC accepts a range of circumstances as reasonable excuse: serious illness, bereavement of a close family member, unexpected hospitalization, severe technical failures on HMRC's own systems, and certain other genuine emergencies. What HMRC does not accept as a reasonable excuse includes not knowing the rules, having too much work to do, being too busy with your business, relying on someone else who failed to act, or not receiving a reminder notice. These are not sufficient grounds to avoid a penalty. If you believe you have a reasonable excuse, you must appeal in writing to HMRC within 30 days of receiving the penalty notice. You can do this through the Gov.uk website or by sending a formal letter to HMRC. If HMRC rejects your appeal, you have the right to request an independent review by a separate HMRC officer. And if that is still not resolved in your favor, you can take the matter to the First-Tier Tax Tribunal, which is an independent body that can overturn HMRC decisions. The most important thing is to appeal promptly. Missing the 30-day appeal window makes the process significantly more difficult. Now that we understand what penalties look like, let us talk about the most effective strategies for avoiding them altogether. The first strategy is knowing your key dates. The self-assessment filing deadline is 31 January. The payment deadline is also 31 January. The registration deadline, if your income exceeds the threshold, is 5 October. Set calendar reminders for all three well in advance. The second strategy is keeping records throughout the year. Do not leave everything to the end of the year. Keep a running total of your gross income and your allowable expenses from the very first payment you receive. Good records make filing accurate and on time much easier. The third strategy is filing early. You can submit your self-assessment return from 6 April, the very start of the new tax year. Filing early gives you time to identify any issues, set aside money for the tax bill, and avoid the last-minute pressure of the January deadline. The fourth strategy is setting aside money as you earn. A good rule of thumb for basic rate taxpayers is to set aside around 20 to 25% of your side income profit into a separate savings account as you go. That way, when the payment deadline arrives, the money is ready and you are never in a position where you cannot pay. The fifth strategy is registering on time. If your gross trading income exceeds £1,000, register by 5 October. Do not wait. Registration is free, takes around 15 minutes, and avoids the failure to notify penalty entirely. This is something that is really important to understand, and something a lot of people do not know exists. If you have filed your tax return correctly and on time, but genuinely cannot afford to pay the full amount by the 31 January deadline, you do not have to just ignore it and hope for the best. HMRC has a formal process called Time to Pay. Time to pay is an arrangement where you agree with HMRC to pay your outstanding tax bill in affordable monthly installments rather than in one lump sum. You can apply for a time to pay arrangement online through Gov UK if your tax bill is under £30,000 and you apply within 60 days of the payment deadline. For larger amounts or more complex situations, you contact HMRC directly to discuss a payment arrangement. Interest still accrues on the outstanding balance during a time-to-pay arrangement, so it is not free money. But it is vastly better than ignoring the bill and allowing late payment penalties and additional interest to pile up unchecked. The key message is this: HMRC would rather receive the money in installments than not receive it at all. Proactive communication with HMRC is always better than silence. If you are struggling to pay, contact them before the deadline where possible, not after. Let us bring it all together. Here is what you need to know about HMRC penalties in 2026. Late filing starts at £100 on day 1 and escalates to over £1,000 in daily charges plus percentage surcharges by 12 months. Late payment adds 3 rounds of 5% surcharges on unpaid tax. Failure to notify can be a percentage of all tax owed, going back years. Inaccuracy penalties depend on your behavior and can reach 100% of the tax due. The new MTD penalty point system applies to quarterly filers from April 2026. Interest at 7.75% per year applies to all unpaid tax and penalties from day 1. Behavior determines how high your penalty is. Voluntary disclosure always reduces it. You have 30 days to appeal any penalty with a reasonable excuse. And if you cannot pay, time to pay is available, but you must apply proactively. Penalties are avoidable. Know your dates, keep your records, file early, pay on time, and if something goes wrong, act immediately rather than hoping it will go away. Please like and subscribe to HustleWise UK for clear and honest UK tax guides every single week.